3:00 p.m. Welcome to the City of Cocoa Beach Police and Fire Pension Board. Let's do a roll call. Dan Adavazio. Here. Chris Kewen. Here. Wes Mullins is here. For the police side, Tommy Blair is absent, and we have one vacant seat.
And roll call for the fire side. Got A.J. Anderson.
Present.
Myself, Laith McCallum, present. Michelle Flynn.
Here.
Dean Rosenquist.
Here.
And Brian Zotto.
Here.
All present.
Okay, any public comment? Hearing none, seeing none. Do I have an approval on the police side for the February 2023 minutes? I need a motion, please.
I move.
Dan, have the motion. Do I have a second?
Second.
Major Kewen with the second. All in favor say aye.
Aye.
Aye. Motion passes.
The expenses paid for the fire side, I'm sorry, minutes first. Everybody read the minutes? Anybody have any discussion on that? Vote to accept them? Have a motion?
Motion to accept the minutes?
Motion by AJ,
Second.
seconded by Brian. All in favor?
Aye.
Aye. Motion so passes.
All right, so for the police side on the expenses paid, are there any issues or any comment on the expenses paid portion for the police? If not, do I have a motion to pass the expenses paid? Motion. Major Kewen with the motion?
Dan, second.
Dan with the second. Any discussion? No discussion. All in favor?
Aye.
Motion passes on the police side.
For fire side, expenses paid. Do I have any discussion? Any questions? Okay. Do I have a motion?
Motion.
Motion by Michelle, second by Dean. All in favor?
Aye.
Motion so passes.
Man, this is smooth.
Don't say that, keep going.
I know. We haven't seen Doug yet. And Carrie. So, Deb,
Yes.
you want to move to F and just kind of wait for Doug to skip E right now? Okay, so if you're good with that,
Yeah.
then we will move on with item F, ANCO, Carrie Richardsville.
Good afternoon, everyone. It is great to see you and be with you today. Hope you're all doing very well. Today we have a couple of materials in front of us. We have our typical quarterly reports, and then that International Equity Value Manager search that we talked about at the last meeting. So I'm actually going to start with our typical quarterly reports first, and then we'll move to the search after, if that's all right. So believe it or not, and I'm going to flip in your books to where the market charts start about page 3. We actually had positive results out of equity markets for the quarter, even despite, some of the real turmoil and ultimately the failures of entities like Silicon Valley Bank and Signature Bank. We actually still ended in a pretty good place from an equity market standpoint. And kind of peeling back the numbers a little bit, what we really saw was, we were kind of off to a good start to begin the year. Obviously, March really kind of threw things for a loop. And what you saw was investors really gravitating towards those handful of or so of stocks we talked so much about. So when we look at that top chart there on the right of page 3, so the S&P was positive about 7.5%. To give you some perspective, about 2/3 of that was your good old Amazon, Alphabet, Microsoft, Netflix, NVIDIA. So really those kind of techie stocks that have moved very strongly in favor over the last few years was where the majority of that return came from for the S&P 500. It was a good quarter for, as you can imagine, kind of technology, some of that communication services, consumer discretionary. Value was positive, but marginally so. Growth was up about 14%. Value was only positive about 1%. So we saw, again, that kind of narrow market leadership out of U.S. equity markets in the large cap space. Mid and small caps were also positive, less so, more like kind of 3 to 4%. But I think kind of surprising when you think about everything that we went through for the quarter. And I think, credit to the Fed for stepping in and first of all, or really the regulators, giving that unlimited FDIC coverage to kind of take care of the very large amount of uninsured depositors, particularly at Silicon Valley Bank. But also the Fed creating this program where if banks do have securities on their books where there's a large difference between kind of the par or the ultimate repayment value and the current value of it, banks were able to borrow against the, what we call par, or the kind of final repayment value there. So it really kind of shored up, gave banks an ability to shore up liquidity if they needed some, to kind of staunch any sort of broader effects of what we saw coming out of Silicon Valley and Signature Bank. And then, just recently, really First Republic Bank as well. I think when you look at those, the cases and what we saw of Silicon Valley Bank and the others, there were definitely unique circumstances there. So for Silicon Valley Bank, their depositors were really heavily skewed towards kind of venture capital companies. So that was kind of a very particular investor base. You saw that really with kind of First Republic as well, a very niche type of organization. And so, I think those particular entities kind of had their own unique challenges, because I think the next question is there kind of a contagion out there? I don't think so right now. I can tell you Silicon Valley Bank, among others, was very heavily invested in what we call long duration securities, where the value moved very far away from par, much more so than their peers. So you didn't see that practice kind of across all financial institutions to the extent that you saw it with Silicon Valley Bank. And it sure seems like, JP Morgan picking up First Republic just here this week is going to be a good thing for JP Morgan. It seems like, there's a lot of value there for the organization. So don't kind of see any contagion there yet. And as I mentioned, equity markets here in the US were positive despite what we went through for the quarter. Overseas markets were strong. This is the second quarter of, pretty impressive strength we've seen out of overseas markets. Part of that may be the fact that they've been cheap relative to the US for a very long time. Part of that is we're coming out of winter. Europe survived with adequate energy supplies, and really has held up a little better than folks expected. And so overseas markets, depending upon what index you look at, were positive to the tune of kind of 7 to 8%, and then even emerging markets were positive about 4%. Interestingly, within bonds or fixed income in that bottom third green segment, even though we got 2 rate hikes out of the Fed, 25 basis points or 1/4% each, actually bonds were still positive. And so what happened was, if we flip in your books to the bottom of page number 10, our good old yield curve chart on the bottom right there, what you saw was the short end of the curve reacted to what the Fed did. So the green line is where we ended 2022. The yellow line is where we finished at the end of March. You see kind of the pop up there on the short end of the curve, but actually rates kind of dropped on the longer end. And that was really a result of investors flocking to kind of treasuries, especially in that second half of March as some of the financial issues were shaking out. So it gave us a positive 3%, out of fixed income for the quarter too. So I think, when you think about what was going on in the backdrop, the numbers in public markets were really pretty good for the quarter. We've talked about, separate real estate and kind of the challenges there. It's very natural that as interest rates rise, borrowing costs for managers get more expensive. Valuations tend to come back down to earth a little bit. So that index was down a little over 3% for the quarter. I think, probably there's a couple more quarters to go for things to kind of shake out in real estate before we start to see it move into positive territory again. But again, kind of a natural consequence of rising interest rates. Kind of valuations had been very high, particularly in multifamily and industrial, and some of that's kind of coming back down to earth a little bit. But the majority of your portfolio, again, the public, equities and bonds really held up very well for the quarter, I think, all things considered. Any questions on the economics piece before we move into the specifics of each of the pensions? Okay, hearing none, I'm flipping in each book to page 13. Forgive me as I hit the microphone with my book there, which is the line graph chart of growth for your plan. Some really nice, long-term perspective here. Police on your side, you all were just over 17 million to end March 31st. Looking at the bottom there, your 10-year return, still a 775, very good. Fire, you all were at about 17.1 million, specifically, 17 million, about 121,000. You all as well, over the 10-year return there at the bottom, seeing that, 7.7% annualized return over 10 years. We've been through a lot through that period. The good news is, up until just recently, equity markets had been really good to us. And so those long-term numbers still strong, still, very happy to see that on behalf of both funds. Just taking a look at your asset allocation for each of your funds. Again, police, just over 17 million for the total fund. Just over 47% of your assets were in domestic equity or U.S. stocks. About 14.5% of the assets was in international equity. 14.5% was in domestic fixed income, just shy of 5% in global bonds, 18% in real estate, and then just a little bit of cash. And then fire, similarly on your side, about 48% in domestic equity, 15% on the nose in international, 13% in U.S. bonds or domestic fixed income, 4.5% in global fixed, just shy of 18% in real estate, and then a little bit of cash on hand for you all as well. And if we flip ahead a couple of pages to the asset allocation exhibit that's a little bit easier to follow, that's on 19. Really, for both of your funds, we are within our asset, with our kind of target asset allocation ranges. So no recommendations to rebalance for you all. You are slightly underweight in both funds. In domestic equity, slightly overweight in real estate. And we do have, some pending redemptions there. So over time that will kind of come back down, I believe. But you are really comfortably within your investment policy limits on both funds. And so no recommendations for a rebalance at this time.
Hey, Carrie, can I ask you a question?
Absolutely.
Real estate. I don't remember where we left it last meeting. I'm hearing that the real estate market, at least is the real estate that we're in residential or is it industrial?
It is quite a few things. So it's residential vis-a-vis kind of multifamily or apartment buildings, and that's going to be roughly a quarter of the fund. It is industrial, which is going to be warehouses, truck bays, et cetera. That's typically kind of 30-ish or more percent. That space has gotten really popular. Little bit of retail, kind of storefront. Typically, that's kind of shopping centers and et cetera. And then office. And office is typically kind of like 20%-ish, kind of low 20s.
Yeah, the office is what's bothering me.
Yeah, and that piece, that piece is still the biggest question mark. I think that is the biggest question mark kind of in the space. When you look at ASB, they were down about 5% on the quarter. Most of that was kind of office-related write-downs. I think candidly that space has just yet to shake out. I think it's going to take some time. I think, return to work has been very slow. One of the companies that kind of tracks badges kind of beeping in and out of buildings, gives a number of about 50%. Some areas, it all depends, it's less than that. So really that kind of return to work phenomenon and the future of work will have a lot to do with, how those office properties ultimately hold up.
Are we good with our allocation knowing that right now? And I'm just asking.
It's a great question. I think, there are queues right now for all of the managers because there's not a lot of transacting going on, particularly in certain spaces like office and retail.
Is everybody trying to get out of it?
Well, some of that and some rebalancing too, because if you'll remember last year, real estate was our only positive asset class and equities and bonds were down. We've made a nice rebound, but we're not all the way back. And so some folks are kind of still overweight, that segment. Wes, I think, I don't purport to know the future of office, so I'm not going to, kind of try to make something up to sound smart. But I do think in a lot of these locations, I think about like a Washington, D.C. office asset or even, I think, San Fran's got its own issues, but something like a Chicago asset, a New York asset, even if office kind of goes out, the locations of those properties are in pretty stable, attractive, what they call Class A cities. I do still think there's value in those properties. In some cases, you're seeing managers turn them into science laboratory type of space. There's still a pretty healthy demand for that. In some cases, they're turning it into kind of multifamily or even kind of like homeless type of, shelter and things like that. So
if you're good with it, I'm good with it. I just wanted to bring that up because that is a problem right now.
Yeah, so we do have some pending redemptions in that we had put in to kind of keep ourselves within the range there. I think to some extent, whatever they've got from office kind of is what it is until transactions kind of come back to the market a little bit. It's definitely something we're going to be watching very closely. But, it kind of is what it is for that roughly 20% until transactions come back to market, price discoveries out there, and kind of, because a lot of these guys, they just can't trade for, there's not a lot of buyers right now
But
in these
didn't
property
we put in
spaces.
redemption? Didn't we put in a redemption?
Yes, you all both funds have outstanding redemptions,
They
that
just
are
haven't been
pending in the queue
executed.
right now. And so you'll get that over time.
So they haven't been executed yet.
Oh, no, they've been executed, but there's kind of a waiting line, and so they're not able to give you all your money back right away. They're giving it in kind of smaller pieces than they would under a normal, healthy functioning market cycle. So the redemptions are in, you're in line. The redemptions you all approved at a recent meeting, you're in line. And so that money will come back to you over time.
Got anything, Dan?
When the redemption transactions occur, does that fund, those dollars go into the cash balance, or does it flow automatically into like total debt?
Yeah, so that's a great question. It doesn't automatically flow, but when we get those monies back, we have the ability to say, like, if we were looking at your 331 snapshot and that was today and we got money back, I would look at your asset allocation and say, oh, we could probably put that to work in domestic equity, or in domestic fixed income. We have the ability to rebalance you when those funds come in. There's no automatically pointing it to one asset class or anything like that.
I have a question too, real
Yeah.
quick. As we emerge out of probably this year, I think there's some interesting things in play, and I'm
Yeah.
sure you're aware, whether out of the storm, basically. But in
Yeah.
particular, certain types of stocks, like telecommunication companies, and specifically Starlink, they're not IPO'd yet, but I'm assuming you guys have a weather eye to that, because that's industry-changing motion. I see it being
Yeah.
huge. So if you have exposure to that, I don't know if you're paying attention to it.
Yeah.
That was my personal question, really, as far as being open to that. As real estate's doing bad, telecom's going to go crazy at some point. Don't know when, but it's going to kick.
So I would say yes. It's not necessarily me. It would be more like an Allspring who's watching in the growth space for kind of new. They're very big on, kind of long-term structural trends, like, way back in the day, e-commerce, AI. So they're very big into kind of up and coming, emerging, kind of next big things, I'll say, trends, developments, breakthroughs. A manager like Allspring, I would expect, would be keeping an eye on something like that and taking advantage if they think that it makes sense.
I see some of our telecom tech holdings that we currently have will also be affected by that one emerging out. So
Yeah, kind of
it's gonna be like-
cannibalization or,
Yeah. Like, I'm assuming Verizon and cell companies and stuff will all start adhering to that standard. So that's my question to them, is like, is there exposure to it, or? Like,
And
it's
if
coming-
you've got any like specific names, let me know, Latham. I'd be happy to ask the managers about that too, and get their perspective. But I would look to particularly your growth managers, your Touchstone and your Allspring, which is really the whole kind of 3,000, to be looking at those opportunities and kind of picking winners and losers and seeing the potential for, kind of the shift change there and adjusting accordingly.
Cool. Okay.
And if I see any commentary or anything on that, I'll keep an eye on it. I'd be happy to share that.
Could I ask one more question?
Absolutely.
Page 21,
Okay.
up at the top, it talks about income, appreciation, depreciation.
Yes.
And net market value.
Yes.
So income would solely be actual income from these funds that we have.
That's
It isn't
right.
appreciation of the fund.
That's right.
It's just
It would truly
income
be
that we get.
dividends and interest payments.
Okay.
Yeah.
And then appreciation would be how much the fund went up.
Yes.
Okay.
Kind of by segment and by manager, but yes, that's exactly right.
So total return would be the income plus the appreciation.
Yes, it would.
Great.
Flipping in your books to 22 for both plans, just quantifying the quarter. Police, on a gross and net basis, you all were up about 3.4%. Fire, you all were up about 3.6%. The benchmark was up about 4.7%. Within the individual equity segments, police, you all were up about 6.7%. Fire, you all up about 6.9%. So again, both kind of in that 6% range for domestic equity. Within the domestic equity segment, Allspring, again, that kind of, large mega to small cap manager that can do, kind of top to bottom there, opportunistically. Up about 14.5%, just each kind of slightly ahead of the Russell growth there, up about 14.4. So overweight to industrials in particular helped them. They had a company also on the healthcare side, Seagen, that was acquired by Pfizer, that does kind of cancer-related work. So that helped them kind of keep up and slightly eke ahead of the index there. Touchstone mid-cap growth up about 8, slightly behind the 9% of the index. They did have a very small sliver, just a couple basis points in Signature Bank. I'm sure that was a bit of a drag for them for the quarter. You all obviously have the Vanguard Extended Market Index, which was up about 5.9. On the value side, Brandywine, that strategy will tend to be heavy financials, so they were slightly positive, about 30 basis points, but the index did about 1%. Financials as a whole were really impacted by what was going on with Silicon Valley Bank, so that caused them to trail just a bit. And then Vanguard Equity Income, also caught by, kind of some of the financial turmoil, but also, I was talking to you about Allspring buying Seagen, the cancer company. Pfizer bought that company and they had the Seagen holding. Pfizer actually was down for the quarter on that acquisition. Vanguard Equity Income does hold a little bit of Pfizer. And healthcare in particular, the pharmaceutical companies were a bit down. Names you would know that are good names, but just kind of under, various pressure points for the quarter there. In overseas markets, flipping the page, growth was really in favor, both overseas and here in the U.S. So your Vanguard Equity Income Fund in both plans was up about 9.9%. The index was up about 7%. Again, in a good quarter for, IT names, consumer discretionary. Some of the handful of names that have done very well for them, ASML and Taiwan Semiconductor, those chip makers were back in vogue. Some of their consumer names, Louis Vuitton, Moet Hennessy, Mercado Libre, did well. And again, the style definitely lifted that strategy for the quarter too. Within fixed income, both funds up about 2.8, pretty much in line with the index overall, which was up 3. So for Dodge & Cox, your fixed income manager, it was a good quarter for corporate credit. They tend to overweight credit, so they eked out a bit ahead there, positive 3.1. The index was up about 3. On the global side, the PIMCO Global Bond Strategy was positive about 2, fell a little bit behind the Global Ag, which was up about 3. They actually have not really had a lot of exposure to long U.S. rates, and it was a good quarter for U.S. rates, and so they fell a little bit behind there. ASB, as we talked a little bit about, down about 5.5%. The index was down about 3.3. And again, most of this coming from, taking write-downs on particular office assets. And the cities that they named in particular were Washington, D.C., Portland, and San Francisco. They are seeing, kind of green shoots. Retail's actually coming back a little bit, so there is a little bit of kind of ebb and flow to the different sectors within real estate. They did say industrial and multifamily were kind of slow. Those tend to pick up in the summer when people move, so there was a little bit of kind of slow leasing activity there as well. And as I mentioned, I do think, for probably at least another couple quarters, real estate will be, kind of challenged as interest rates are higher than they've been. Just, again, makes borrowing costs much higher. And if transactions aren't taking place, that's a challenge as well. Any questions on your performance, your managers, or anything for the 331 books for the plans?
If you had a crystal ball, which you
Yeah.
don't, but break it out for 1 minute.
I'll try.
And are the rates going to stay the same or higher to the end of the year?
That is a great question. So the Fed meets tomorrow.
Yes.
Consensus right now is 25 basis points more, which puts us slightly north of 5 on Fed funds. Consensus by markets is that they hold for a little while and end up starting the cutting process by the end of the year if they send us into recession. The Fed thinks that they hold for a while and they're probably not in kind of cut mode until next year.
Okay.
I definitely think they'll hold for a while after Wednesday. I think, there are lags in things like, the inflation's run a little bit hotter than they want, but there are lags in things like some of the CPI data. Some of the kind of the residential and rent piece has been a big kind of piece that has remained elevated, but there's a 9-month lag in kind of the way that that's reported. So I hope and think they will kind of take a pause, take a breath, and let the data play through a little bit before they do anything else. I mean, I think, what we saw over the last couple quarters was what is to be expected when the Fed is hiking and they're hiking aggressively. They're going to break things, and they broke some things that impacted the financial sector. And I think, with higher rates, you're going to continue to see that. It's more expensive to borrow, to refinance debt. So I think and hope they'll take a pause and really evaluate before going much further. And that seems to be the consensus, but things change every day, so
And-
Thank you for that.
yeah.
And the forecast is after they pause, they'll continue raising, or do you think they'll be declining?
At this point, it looks like they think they hold for, another couple quarters. The market thinks they end up cutting, even in the end of 2023, even later this year. So I don't see any indication that they continue hiking, but again, that could change at any point.
So, if I understand correctly, a bond that you buy at a higher interest rate and rates go down, the bond gains capital appreciation.
Yes.
Plus, you still get the interest on the bond, right?
You get the stated coupon, yeah, whatever that.
Coupon plus appreciation on the bond if you want to cash it in. So if we think that
Yes.
rates are going to stay pretty high, maybe more fixed income might be worthwhile to look at.
Yeah, I mean, I think that's a great point, Dan. I mean, the aggregate is yielding something like 5% now, so it's kind of this wonderful environment for savers where fixed income finally has yield again. So, I mean, yeah, I could definitely see putting more in fixed income at this point in time. Because you're right, we'll get a pop if rates drop, we'll get a pop from a pricing standpoint,
Yeah. So from that standpoint, is there anything you think we ought to be out of and move into bonds?
The one thing I would say is depending upon your outlook for kind of U.S. performance versus global, international equity seems poised to continue to do well because the dollar is finally depreciating, and it looks like maybe that will kind of continue to be the case. The only kind of sector that portion of your portfolio that I would say we could kind of think about would be the PIMCO global bond, because it is hedged, so you're not getting the benefit if the dollar depreciates and kind of those foreign assets do better. You could kind of underweight that piece a bit and put more in your domestic there. That would be something I think you could do. Again, because you're pretty close to the bottom end of your range in domestic equity, I wouldn't necessarily kind of touch that. You're pretty much on target in international equity, but I think the outlook there is pretty good. But I think if you wanted to shift kind of some of the global in favor of more domestic, I do think a trade like that could make sense. Because again, that global strategy is hedged. You're not getting currency effects there, you're just getting rates. So you could, kind of focus more on domestic than on global there. That could make sense.
You want to think about it, or you want
Well,
to discuss it?
it's all a crapshoot, right?
Yeah.
But I know that when we get a 5% return in a government bond, and we're looking out that after this rate increase, we might not have a rate increase for the whole year, and we could collect 5%. And if we get a rate decrease or quantitative easing again because they're worried about a recession and everything else, and the Fed decides to start cutting rates, those bond values are going to go up dramatically, plus pay us 5% while we wait. And if we could do 5% our whole lives in this, we're doing pretty good as a pension
I
plan.
agree. Yeah.
Which actually asks, how much of this do we actually have in cash? Do we have anything in cash?
You don't have kind of much in your R&D account. It's, as of print, it was about, so this is police, this is fire that I'm holding. Fire had about $250,000 in cash, strictly in kind of the R&D account where we pay benefits, et cetera. And let me look at police. And both of you had, I actually pulled your interim values, both at you, about 210,000, but both of you had less than that as of the kind of, May 2nd update or May 1st update that I.
Is that cash in a money market?
Yes, it is in a sweep that's getting, kind of mid-4s there. So you are getting paid for
We're
having those funds.
rolling mid-4s on the cash
Yeah.
as it sits, and then we can get into a bond that's 5.
Yeah, and if it goes up, we're gonna make more money. If rates go up higher, we're gonna lose a little money on that. 4% of money market fund is pretty decent right now.
Yes, sir.
I was thinking more on one of our equity funds that we just didn't think was performing well.
So I think, the most challenged segment of equity continues to be that large cap growth segment, just because of the what we call, again, narrow market leadership, which is just a big way of saying, very few names have very materially moved the index and been responsible for most of the performance.
Me too.
I think really, Dan, the rest of your lineup has done very well. So there's not a lot of places where I would say, and I don't want to make a style bet and say, let's take away from value or something like that, because we've been swinging in and out, kind of from a style standpoint, growth, value so much. It would be hard for me to kind of pick a manager to.
I don't want to get us whipsawing. We're
Yeah.
in this today and out tomorrow and in
Right.
this. So maybe we should just kind of let it go if we really don't have excess money.
Yeah,
But
and
if we end up getting some excess, we might want to think
Yeah,
about it.
and I think about a year ago, back several quarters, when real estate was really booming, that's when we made the decision, both plans, to really allocate more into real estate. And we would have never thought back then, we're sitting where we're at right now, even in our own county on real estate. So I think looking at this as a pension plan fund and not chasing a marketed and equity funds and chasing the booming styles going forward, we really need to look at the plan in totality and look at the 5-10-year capital gains we've received, because it is a pension plan fund and we don't want to see those curves and us get in the pattern of chasing them.
Yeah.
So my recommendation would be we hold still until we can have the pending real estate redemptions actually realized,
Yeah.
and then maybe put them into the bond funds. Because we still do have on both plans some of those redemptions waiting there, which is some sizable cash.
Yeah.
So maybe building back up that cash is what I would recommend, and then waiting a little bit and seeing where the bonds are next quarter, and as those redemptions come in, putting them into the bonds. That would be my
Yeah, that'd be
recommendation.
great.
Yeah.
As we
That's my
redeem
recommendation.
out of the real estate, if we get our, as we get our.
Yeah, we still have them pending, so
Move it into
I
the
think,
bond
and
fund.
it could take a while to the real estate comes back. We know long-term real estate will come back, but it still could be another 2-3 quarters.
That's right.
At least.
Yeah.
At least, yeah.
Very good. Okay.
I
And then,
have a question.
yeah, please.
I don't know if you know, but I just got an email from the city clerk and that it looks like the governor has signed a bill for a pension plan investment. Do you know anything about that?
I think Pedro will talk about it.
It's House Bill
It's
3.
what I'll call the anti-ESG legislation, but I think Pedro will cover that. I know that he has in other meetings, and if, we'll all kind of chime in there as need be, but we definitely know what it is, and it's definitely on his radar too.
Okay, all right, so I'll make sure.
Okay.
I just went through it. Just thumbed through it. It's interesting, but it's protections in there for decision making and stuff. It's
Yeah.
basically the gist. So.
The other item that I had in your package, though, was something we discussed at the last meeting, which was in the international equity space, you all just have that Euro-Pacific fund that does have that growth orientation, so it'll do more in, technology, kind of consumer discretionary. We don't have kind of the value counterpart that may do industrials, materials, kind of financials, et cetera. And so what we did is we pulled some value-oriented international equity managers that we follow that we could take a look at to consider pairing with Euro-Pacific for both of your plans. And to give you a little bit of an idea of size, right now Euro-Pacific's at about $2.5 million to $2.6 million. So we could consider a value manager, and if you wanted to pair them 50-50, which I think makes sense, the size would be about 1.2, 1.3 million, just to kind of give you an idea as we walk through these. And the funds that our research group came up with that they thought were good pairs for Euro-Pacific are kind of right inside that book if you flip to page 1. So the candidates, and these are all mutual funds, which is what you have, currently, is a product called the Ariel International Developed Institutional International Equity Value Fund, the DFA International Value Fund, Dodge & Cox International Stock. You all know them. They do your fixed income, but they're kind of a value-oriented shop on the equity side, so that's their value equity product internationally. And then Transamerica International Equity. And just to give you an idea of fees, DFA, second from the top there, is the cheapest. Their fund is about 30 basis points. Dodge & Cox comes in second at about 62. Transamerica comes in third at about 75 basis points, and then Ariel comes in fourth at about 88. To give you a little bit of perspective on the disparity here, DFA is a quantitative manager, and what that means is they built a model, they kind of run all the international equity stocks through that model, they capture what they believe is their definition of large cap, they screen based on that for profitability measures, cheapness of the stock, things like low price to book, reasonable PE ratios, and they kind of move forward with whatever goes through the screen. The other three managers are what we call fundamental managers. So they look at companies kind of bottom up. They may go visit those companies. They're analyzing their financial statements. There's kind of a lot more work that goes into vetting those more fundamental strategies, and you see that come through in the fee difference. So I thought that was kind of a natural question. I'd just kind of jump in and explain that a little bit. When we move ahead to page 4, that's kind of the introduction to the firm information on that page. Within the top segment there, all of these firms, and I'm just kind of jumping into that top section, but summarizing what you see there. All of these firms have been around almost 40 years, some of them much more than that, Dodge & Cox going back to 1930. So very well-established firms. Again, the youngest two, which are Ariel and DFA, going back to the very early 80s. Most of them independently owned, meaning their employees have some or most of the kind of share of ownership, except for Transamerica, which is a subsidiary of a company called Pendal Group. And really, all decent-sized shops. Ariel and Transamerica are a little bit smaller, and that's $16 to $18 billion size, but still pretty good-sized shops. DFA and Dodge & Cox, really behemoth shops, kind of in that 300 to 500 billion in size. If we get into their particular international equity strategies, that's on kind of the bottom section. And again, pretty good tenure for the strategies that I will show you. The youngest one is Ariel, which has been around 12 years. Transamerica has been around 18, Dodge & Cox 22, and DFA goes back 30 years with their international value strategy. Each of these managers, what they want to do is add, just 1% or 2% above the benchmark net of fees for you. As I mentioned, 3 of them are those fundamental stock picking managers. DFA does have that kind of quantitative model there. They all have, plenty of capacity. So typically we look at, the size of the strategy and how much we think they can manage, but all of these managers have plenty of capacity, so that's not a concern. As it relates to kind of how the firms manage their funds, if we flip to page 5, that kind of top section there on page 5, the team information. Ariel and Transamerica have one named kind of main portfolio manager, Miss Bonsali for Ariel and Brendan Harrell for Transamerica. DFA and Dodge & Cox take more of a committee approach. And really for both firms, that's what they do for all the funds that they run. They've got, investment committee and kind of risk committees that really drive kind of the top-down view, and for DFA have input on how the model works. And those committees really kind of provide leadership for the management of the individual funds. When it comes to kind of their individual styles, I'm looking in the bottom section, and I'm only going to pick kind of a couple of items out of this. But when we look at these 4 managers and how they manage international equity, managers like Ariel and Dodge & Cox, they're going to overweight, China, and will even do some in the U.S. They're going to typically underweight Australia. Ariel also typically underweights Japan and the U.K. DFA does not show any kind of country, preferences or dislikes. They tend to stick very close to the index weights for country, and really Transamerica does not either. 2 of the funds, Ariel and Transamerica, are able to do a little bit of emerging market, up to 10%. DFA and Dodge & Cox do not. Most of these managers, from a kind of a sector, so how much do they do in healthcare, how much do they do in technology, do stay somewhat close to the benchmark. So Ariel's going to stay within 1.5 times, kind of the benchmark weight, but they'll also limit any particular sector to 25%. DFA, pretty similar. They're going to be plus or minus, 10% of any sector weight with a maximum limit of 25% for industry. Dodge & Cox, worth noting, they do not have any kind of sector constraints or limits. So they tend to be in sectors like, technology, they'll do some financials, they'll do some energy, but they do not have parameters around those. They're kind of more unconstrained when it comes to sectors. And then Transamerica will be plus or minus 10% of the benchmark weight for each sector. So that is has a little bit more kind of guardrails there, as I mentioned, than Dodge and Cox does. Ariel does not typically kind of over or underweight any particular sectors. DFA, for all of their strategies, they do not do REITs or utilities. They think that REITs act more in accordance with what's going on in the real estate market, not necessarily the equity market. And they also don't like the upside potential for utilities. They just think they're too regulated. So they don't typically overweight any sectors, but they will not be present in REITs or utilities in their portfolio. As I mentioned, Dodge and Cox, technology is always a big one for them. They tend to do a lot of financials and energy too. They will underweight consumer staples. And then Transamerica, they do like the industrial space. They'll tend to overweight that, but they will not have any kind of persistent underweights. All of these strategies you should expect will be very diversified, anywhere from kind of 50 to 75 that you see for Ariel to several hundred for DFA, but all very diversified. And just as a refresher, so is Euro Pacific. Euro Pacific typically has 200 to 300 securities or more. So all of these very diversified strategies. And then the last thing I'll just say on this page is, some of these managers will hedge currency, some of them do not. So Ariel and Dodge and Cox do deploy currency hedging. DFA and Transamerica do not. That means, depending upon how you feel about the dollar, if you want the currency headwind or tailwind, you will get that from a DFA and from a Transamerica, but not from the other two. Just quickly, and I'm just touching on a couple more pages on page 6. On that page, I'm in the second section, which is characteristics. Under that average market cap kind of section, if you look all the way over to the far right, the value index, about 34 billion is kind of the average market cap for that index right now. You can see Ariel tends to be a little below that. So does DFA, both of them kind of at 29 billion. Dodge and Cox doing a lot of large and kind of mega stocks, so they're more like 46, 47 billion. And then Transamerica, from a size standpoint, pretty much right on top of the index. If you look in the next box down, GICS sectors, just kind of looking at where the managers tend to kind of gravitate from a sector standpoint, almost all of the managers, their number one kind of sector is financials. Financials is a very heavy weight in the value index. It's about 30%. So for most of these managers, except Transamerica, that's their number one kind of sector, but you'll notice none of them is overweight there. They're either close to the index or behind that a bit. And then you see, kind of they vary a little bit from there. So Ariel doing quite a bit in, healthcare and consumer staples. For DFA, their next heaviest weightings are in energy and materials. For Dodge and Cox, again, back to healthcare, a little bit of consumer discretionary. For Transamerica, consumer staples actually and industrials. So each of them kind of taking a pretty different approach there from a sector standpoint. Just a couple more slides and then we'll get to the conclusion here. I do want to show you the style map, and that's on page 11. And the right-hand side map is really the one that I want to kind of focus on for just a moment. The red squares that you see kind of high and to the right, that's how Euro Pacific maps. So very kind of high, large to kind of giant companies, very far over kind of on the growth side. And then to the left, you can see how the managers map accordingly. Ideally, you'd want them to be pretty far apart, and they all are, but just kind of showing you from a style and really a market cap size standpoint how those other managers tend to map against Euro Pacific. Getting to the good stuff on 13, and that's performance. And these numbers are going to be net of fees because these are mutual fund investments. I'm just going to walk through a couple of the time periods, and I'll start with the 3-year. On the 3-year basis, DFA, really the top performer of the group, up about 20.5%. The index up about just shy of 14. Dodge and Cox kind of coming in second. Looking at the 5-year, all but Ariel, those managers all pretty much on top of each other and all comfortably ahead of the index. They're, kind of up in the 2.8, 2.9 range. The index was up about 1.2. Looking out on a 7-year basis, again, DFA coming out number 1, Dodge and Cox kind of closely behind there. And then on a 10-year basis, again, kind of DFA and Dodge and Cox horse race. But when I think about you all, and really, you know, we need the exposure, and I'm kind of a fan of doing that in an efficient and a cheap way. I like a DFA for you all. Again, very low fee, but they've done a very efficient job over time, you know, giving you that exposure and candidly beating the benchmark. So I like DFA for both of your plans to pair with Euro Pacific, and it would be my recommendation to cut that Euro Pacific fund in half for both funds and to complement it with that DFA International Value Strategy. And I know that was quite a bit of information, so I'm happy to expound on anything or answer any questions that there might be.
Any discussion on Fireside? Of information, but your recommendation is DFA.
It is, yes. I think it's very efficient, you know, low cost. Yes, AJ.
Energy and materials,
Yes,
that's where they're at.
yes.
I like that too.
So the only thing I really see on it, it's cheaper and it performs better, so it's almost crazy not to go with it. But does it bother you at all about the higher PE on that and the higher price to book on both?
It doesn't at this point, and I think, you know, there's a little bit of ebb and flow there. That's really what, they're looking for kind of quality, and they want to pay, you know, kind of a low price for that. And so that'll ebb and flow a little bit. So it's a great question, Wes, but I'm not concerned about it. I did
Okay.
notice that too, but I'm not concerned.
Okay.
Because they're kind of constantly looking at that and adjusting and getting feedback from the model on that.
So,
Any discussion with you guys?
I would put DFA after reading this.
I guess we would need a motion.
Yes,
Pedro?
please.
Yes.
Yes.
Okay.
Nope. Sorry
So-
about that. It would be, yes.
So the motion would be to split the Euro Pacific Fund in half, keeping half in Euro and the other half going to DFA.
That's exactly right.
Okay, do I have such a motion on the floor? Dan, do I have a second?
Second.
Second, Major Kewen. Any further discussion? Okay, all in favor?
Aye.
Aye. Motion passes.
The same language, so well articulated by Wes. We have a motion to split and go with DFA. Okay, motion by Michelle. I'll second that motion. All in favor? Aye.
Great,
Motion
I
so
will make
passes.
it so. And I'm almost done, I promise. I do want to pass these out in honor of Tommy. I know he's not here, so I will email this, or maybe we can email to him. But I know he likes to see, you know, kind of where you guys are. So this is an interim update, and I pulled the values actually today. So just kind of letting you know, you're both kind of hovering right around that $17 million mark. And obviously, we would have just made benefit payments at the 1st of May. So essentially, you're pretty flat to where you were in the book. You're very welcome. Just wanted to give you that update. And then 2 very quick info items, 30 seconds or less, and I swear I'm done. The first is just kind of in looking back at the history of the relationship. It's been about 6 years since we've revisited our fees with you guys. So probably in August, when we do the budget, I will come with a proposal there to make an adjustment. You know, I think we all know and feel, you know, talent, software, materials, resources, all that's gotten more expensive. And so I will provide that in advance, but I did want to set the expectation. I, you know, would like to make a proposal as it relates to fees at our next meeting. And then last but not least, I just wanted to tell you all, you know, a couple meetings ago, we had talked about switching the vehicle for our Brandywine, going into their CIT versus they created an ETF that we went into. So Debbie and I went through the process and doing all the setup, and candidly, that CIT uses an administrator called Wilmington Trust, which is like, you know, a separate entity. And the customer service experience that we had was just really poor. And it's kind of led me to say, you know, let's keep the ETF for a while and see how that does, because I'm afraid that if we use that, you know, the commingled fund and the customer service is poor, it could hamper our ability to, you know, deposit, withdrawal funds, and just kind of it adds some operational complexity that I don't think is necessary. So just fully candid, was not pleased with the customer service experience from Wilmington, and think, you know, we'll stick with the ETF. We always have the ability to get in because all the groundwork has been done if we want to switch over to the commingled fund. But just kind of, you know, had a taste in my mouth after we went through that process, and the responses were so really slow and inadequate. But you still got really the same exposure, it just would have been a different vehicle. AJ.
I'm
in another I'm in a pension plan, another fire department. And the consultant is Brendan
Yes,
V.
yes.
Is he also going to present that to Miami Beach? Or do you know?
Are you talking about the?
The fee.
Oh, I don't know. It really kind of varies plan by plan. So they may be currently in their fee contract.
I can
It
research
really
that.
goes kind of client by client. So I don't know. I'd be happy to ask him, AJ, if you'd like to know. But it just kind of specifically in looking at this one, the last agreement we signed was January of 2017. But Miami, your other pension may be currently under, an existing fee agreement.
I'll look into that.
Okay.
That was a 20-year agreement we signed.
Twenty is fine with COLA.
Oh,
Right.
that's it.
Right.
So is there any paperwork that needs to be done on this?
Yes, I will send you letters. It's truly just a letter, so I'll do them for you, Debbie, and get them to you for signature. And that's all that I had, unless anybody's got anything else for me.
No, thank you.
Okay, thank you. Thanks for the time. I appreciate it. I know it was kind of a lot today, so thank you.
Thank you for your time.
Okay. Reaper, here he comes. Item E, Doug. Don't fear the Reaper, Doug.
You call him the Reaper?
I did.
Blue Oyster Cult 1975,
I did.
maybe? Is that of
That's
it?
a pretty cool nickname, man. That
Yeah,
sounds not bad.
Doug the Reaper Lozen.
Yeah. Well, it's not that bad. Let me get the iPads. I'm gonna get the passwords in, so I don't have to hassle all of you with this. And I'll pass them out. I flipped my coin, so police are up first. Unless you guys flipped your own coin and. All right, let me, one more. I apologize because I don't have enough iPads for a joint meeting, so what I'll do is ask, I'm gonna start here, and if you're police, just take one and pass it down.
We only have 3, so we're good.
Okay. And I apologize, I obviously know who the two are with uniforms. Who was the third? There we go.
He's undercover.
Yeah, undercover.
Yes.
Right.
Okay, so you all know I like to keep it KISS principle. Keep it simple, stupid. That's what I had several professors tell me in high school, so I like to keep it high level. The trustees will get me into the weeds if, as needed, but I like to cover the funding requirements right up front because they always change, tell you why they changed, get you an update on your funded status, and let you know where I think maybe short-term crystal ball is taking us. From there, if you want to get into particulars, but I think that covers like 95% of what everybody's interested in as trustees. So I assume the iPads are still going?
Yes, sir.
No password needed. Okay, so this is the police plan. If you look at the top, it says summary of report, but the word police is near the top. And I double checked, it is Cocoa Beach, so. And by the way, I had this pang of sadness coming in off the Minuteman today. I knew that we were at a different place, but the old city hall's just grass. I mean,
Yeah.
I know you guys, you live here, so you've seen, when was that torn down? I knew that was in the works.
6 to 8 months ago. The new one's beautiful, by the way. It's phenomenal.
Oh, I bet. I miss.
The dream model, put it that way.
I've been in Florida for, over 3 decades, so, we're in Fort Myers, so I'm sad to see all the islands and the beach rebuilding with all these, because Ian wiped everything out, so I hate to see these little quaint places. The City Hall, doesn't that herald back to the space race days, right? Right around 1960?
That's this time, yeah.
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 It harkens back to surviving about 45 hurricanes. So.
I'm waxing nostalgic here, so anyways. So on to the police pension plan. So the 2 columns on the summary page, it's a modest increase in the city's requirement. 24.4% of payroll for the current year, and rising to 26.2% of payroll next year. Payroll's a little over $2 million right now. And the city this last year put in $544,000. So in dollar terms, I mean, it's not going to be a bank breaker. It's going up a bit. But I do see the cost going up, phasing in over the next 3 to 4 years. And when I say phasing in, I think you all have a sense that what happened in fiscal 22 for investment performance, we're only recognizing part of that. Remember the actuarial voodoo that we do? We use a 4-year smoothing on assets, the smoothing technique. And you probably don't really pay much attention to that from one year to the next because usually you don't have any wild swings. Well, the wild swing happened. Fiscal 21, about a positive 21%. We expected 7+, 7.4, I think. 12 months later, minus 18. Okay, so when you have those kind of swings, thank goodness that we smooth, that we use a 4-year average. Because if we didn't, when I was here a year ago presenting, everybody would have been popping champagne corks because the cost would have dropped a lot when you get a 21% return. And then this report would have looked a lot worse than just 1 or 2% of payroll. But smoothing is just a method. It's just a technique to take the volatility off returns on the market. We will be phasing in that loss. Just like we're phasing in the gain from 21 over 4 years, we're going to be phasing in this loss over 4 years. They're playing off each other to some extent. But I do think that the cost will be going up over the next 3 to 4 years, even if we just perfectly meet our assumptions going forward. So I didn't want you to think like, oh, yeah, we've heard about the minus 18, so well, look at this, it's not so bad. Well, it's, more of the impact is coming, okay? But you have to see the actuary each year for me to measure everything because it's not just what happened in the past that we factor in, it's what happens in the future.
But if I heard you right, is it still a net gain between the 21 and the 18 loss?
No.
Okay,
No.
that was a pretty
You
quick
might
note,
think,
though.
it's like, wait a minute, a positive 21 and a minus 18, that's a positive.
Yeah, in my stupid head, that's
It
what I
only
think.
is if your assumption is a 0 return.
Okay,
Our assumption is 7.4. So in fiscal 21, we beat that by about 13 plus, right? Because 7.4 is our baseline.
I'm with you.
Here's 21. The next year is minus 18. Well, minus 18 is 18 from 0. So we fell short by over 25.
right. Because 7 is your 0. 7's your...
Correct, yes.
Okay.
Yeah.
I understand.
So, and anyway, so, I'll be phasing that in, but you did get good information today, and so far, these plans are doing pretty well for fiscal 23. You're beating the 7.4 right now, so hopefully we can get more gains in the future to help somewhat minimize fiscal 22. But if, you hear the actuary, it's not just investment performance, there's other things that go on. Salaries for the police plan came in a little above average, so there was a little bit of a salary loss. And there was a savings part, and that's on the mortality side. We had, I think, 3 retirees pass, 2 retirees and 1 beneficiary. Those monthly checks have stopped. So when we measured that on the retiree liability side, it went down more than we had expected. So there was a little bit of a cost savings there. So when the actuary's done and we settle it all out, funding impact is about 1.8% of payroll. That's the difference you see here. Any questions I can answer on this page? I just want to get you an update on the funded status and then call it mostly done before I move on to fire. If you jump over to page 18, in spite of what I said about the cost going up the next couple of years, your plan still is well funded. And this chart shows that yes, there was a bit of a pullback in fiscal '22. The funded status dropped from 85 to about 83. Not horrible. It's possible that you get down maybe in the upper 70s to 80 the next couple of years. Just depends on what happens going forward. But thereafter, it'll start growing again. When you see a funded status pull back, the solution to it, unfortunately, is you go to the city for more money to be invested. And that will get the funded status rising again. But I just wanted to give you a sense that 1 year of poor investment performance does not equal, tragedy for the funded status. The funded status is still above 80%. And if you look at this trend over the last 10 years, most years it does grow from 1 year to the next. So my opinion is the plan's actuarially sound. I'm comfortable with your assumptions. We just did an experience study a few years ago. And so I think the plan's running fine. We'll just have to phase in the last 2 years of investment performance over the next 4 years. So for the police side, can I answer any questions or get into any other details? Okay, then what I would ask you to do is if you could pass your iPads over to any of the firefighters. And I'm gonna do an exercise here. This is interactive. So once you get the iPad, if you tap the screen, and I'll come up if I screw this up, tap the screen, and upper left there's an arrow that points to the left. Hit that. And you will see Cocoa Beach Fire Evaluation pop up in the library. And just tap that, and it will take a little bit. It's downloading from the cloud, so you might have to tap it just a couple of times. It worked for me. It doesn't mean it'll work for you, but I will come up and help out if possible. So.
Just the instructions, can you repeat? Sorry.
Yes, tap the screen.
Tap the screen, got it.
And look in the upper left. You see an arrow?
Yep.
Okay, hit that. That'll take you back to the library.
Yep.
And you should see a fire evaluation. We're way out in the boonies here, so I think there's only 1 or 2 bars I'm pulling in from. It's pulling it from the cloud. Success? Okay.
I'm still waiting.
All right. Very similar information for the fire plan. A little bit different baseline, but the impact is the same. For the current year, the city's requirement is 23.97% of payroll, and it's rising to 25.37% next year. Payroll's a little different as well, but a very similar impact. The 4-year average between the two plans is very similar, and the -18 for the year is pretty much, it's not exact, but it's very, very close. Good news on the fire side is you didn't have any retirees pass away. So while the police side had some reduction in liability for 3 retirees passing away, I'm happy to say on the fire side, no one passed away. So you didn't have that bit of savings. However, well, I think to the detriment of the fire, but maybe it's just 1 year lag. While the police officers got higher than average salaries, the firefighters didn't. I don't know if that's going to change this year. I know there's 2 different groups that bargain with the city. But the salary increase in the firefighter side was a little below what we expected. So there are different moving parts between the two plans, police versus fire. And I should also mention with fire, the same as police, the state monies that are coming in each year, that goes all to the city. That was negotiated years ago. So you're probably all aware that many plans in the state of Florida have share plans where some of the state monies go to the members. Here at Cocoa Beach, both police and fire, all the state monies go to the city to help fund the plan. So any questions on what I've covered so far with the fire? Then let me get you an update on your funded status. That would be page 18. And the fire plan is funded a little bit better than police. There's no simple answer as to why, because I would have to go back many years in time and see. It's not dramatically different, but instead of where the police was about 83 right now, fire's at about 88, a little bit higher. And you can see that, as with police, over the last 10 years plus, the funded status has more or less risen each year. You know, you go back a decade and even a little bit more, and the funded status was 50s and 60s. So for both plans to have shot up into the 90 range and even holding into the 80s is very good compared to just 10 or 12 years ago. And as with police, I don't think fire will fall below 80 over the next 4 years. I think it will stay in the 80s. But we will be going to the city for some extra contributions to make up for the investment loss. But it's those monies getting invested that will help keep that funded status at a reasonable level. So I'm going to call that done as well for fire, unless you have any particular questions that you'd like me to get into.
I saw one thing, I think we changed the rate of return, and the city was hit with that, I say hit with it, but they caught up the slack, I guess, the market was performing low. But your last recommendation was about 2 or 3 meetings ago. You see the dip off here, is that's capturing that 2022 performance? Basically, we're on a slope up for our unfunded liability, like we were at 90% or 90-something% funded.
Yeah, 91 last year.
And that dip down, is that just strictly attributed to the market performance?
Mostly, yeah. I'm looking at the change in the unfunded liability. The investment, the 4-year smooth average, that's the lion's share of the reason the funded status dropped from 91 to 88 or so. Okay. There were a couple of other things that were fairly minor.
And that smoothing, that year's gonna be a factor moving forward for the next 4 years or so it's gonna be a little staggered, okay.
Yep. And by the way, the performance for both Cocoa Beach plans is right in line with what I've seen all around Florida. You're right, you know, that positive 21 followed by a minus 18, that's very similar. Question?
Yeah, is there like a minimum threshold number on this history of funding progress that if, you know, we got below that number that we should be very concerned, or?
No, my concern would be if I see that chart over time and it's not doing this slow and steady growth over, say, a 10-year period. If I see something like, hey, you've been meeting your assumptions, but the funded status is staying flat and not growing,
right,
that would tell me that your assumptions are out of sync with reality. That's why we go through the experience study every 5 years, is to fine tune and keep this slow and steady progress. But there's no absolute number. I would say, however, if you were like at a 60% right now, when most plans in Florida are in the 80s or 90s, I'd say, yeah, something's screwy. But your funded status is right about where every other plan in Florida is right now.
Thanks.
I think I read ahead, I think when this first came through email, come through it, I can't find the actual page, but it showed like almost like a projected payoff date if things went for the trend. It looked like it was 2034 or something like that.
For the unfunded?
Like 0 unfunded, yeah.
Yeah, looking at fire, it's a 15-year payoff for the unfunded. And I think for police, it's probably, it's got to be about the same. Yeah, we add or subtract to the unfunded every year.
Yeah.
And we pay it off over 15 years. So we're actually adding new 15-year layers every year. So it's always going to have a 15-year payoff. What I hope is that after the next 3 years, we can start adding positives to it, and it'll accelerate the pay down.
Yeah. And my next question, my final question for you would be, I know the fire department was awarded the SAFER grant and is picking up 6 people. And over 3 years, the grant expires and the city then assumes them, and they'll be full-time employees. So we're picking up 6, we're adding to that number that we're at, whatever, 27 or whatever now. We'll be at 33.
Yeah.
And I think I asked you that question before. When you add new members to the plan, it drives down the cost because they're contributing as well. So
yeah, yeah, when you add payroll and you add new people, the percent of payroll will stabilize. Because those new people coming in are 25 years from retirement.
Yeah.
And they're putting in their contributions, and the first couple of years, their contributions are helping the unfunded liability, because they're so far from retirement. But in pure dollar terms, when you add headcount, the city's going to be adding dollars to the plan. There's no doubt.
Yeah. Okay. Cool. Answered my question, so.
Other questions? Okay, then if both boards are comfortable, then it would be a time to approve each valuation report.
Motion to approve.
Motion to approve from Major Kewen. Second with Dan. Any further discussion? All in favor?
Aye.
Aye. Motion passes for police.
And for fire, do I have a motion to accept valuation report as written? Motion by Dean, second? Second by me. I'll do second. All in favor? Aye. Aye. Motion so passes.
Okay, appreciate it. And there is a little exercise. You want me to give you the segue, Carrie? You want to do it?
Beat it to death for 5 years.
Let's see, it's, if you want to do fire 7.4.
So there's this exercise that the state looks for us to do after every actuarial valuation is approved, and it's this language that we submit to the state in a letter, kind of declaring our expected rate of return for the next year, the next several years, and the long term thereafter. And it's really a formality. It doesn't tie your hands from changing that, next year or the year after. It's something that it's just a checked box from the state. So you said fire first.
Either one, because they're both at 7.4.
So both of you all, your expected rate of return is 7.4%. What we would need to do is make a motion to declare your expected rate of return at 7.4% for the next year, the next several years, and the long term thereafter. And I've heard other attorneys let their plans say so moved, so you don't have to actually say that. But we do have to make that return declaration. And if you all do kind of separately make those 7.4% return declarations, I'll work with Debbie to get the filing to the state to that effect.
Is this a motion? As a motion?
I could have said it better myself.
Yeah, I have a so moved. Any objection? Chris?
No,
Are we all good with it?
yeah.
So moved.
Well, didn't she say?
And then I think all in favor, we do need a vote and an okay. And then you should be good.
All in favor?
Aye.
Aye. Motion passes on the police.
Okay, for the fire side, if I have a motion for the assumed rate of return to be 7.4%.
Before that, what did Pedro say? I couldn't hear him.
He said he couldn't say it better himself.
Oh, okay.
So moved.
Motion by Dean. Okay, I have a second?
Second.
Second by Michelle. All in favor?
Aye.
Thank you.
Motion
That's
passes.
great.
Thanks, Darren.
Thank you.
That's it for me.
Thanks, Doug. Good to see you.
Good to see everybody. So, next year, we won't be here next year, will we? Doesn't matter, I'm just curious.
Oh, it'll be.
Will we be here next year?
I
Probably.
think so?
Next year this time?
Yeah.
They're gonna start building in September, I think. So
Is it,
we'll
is
see.
it on the, where's the new location?
Same place.
Same place.
Just west of it, where the parking lot is, the building's there,
Wow.
faces the grass. That's man shell, clam shell, open area, and we
Wow.
can send you a link to the dream. So.
Cool. Look forward to
Yeah,
it.
it's beautiful, yeah, I love it. It's great. Yeah. We'll see what happens.
Yeah, cool.
How's Fort Myers?
There go our taxes, right? The tax-
You would not believe the traffic. I mean,
Yeah.
first, Fort Myers, everybody in the world wants to move there. You guys know what that's like. I mean,
Yeah.
and then, not only that, but then all the construction, the insurance people have to live there for 2 years. But the good news is, I'm driving by a Dairy Queen this morning and I saw a welder putting the sign back up, so.
Wow.
I thought, yep, just in time for hurricane season to blow down again, so. Oh, well.
Such an optimist.
It's better than ice storms where I came from, so,
That's true.
Well, thank you, Doug.
Yeah, good to see everybody.
Thank you. Appreciate you, yeah. All right, the closer. Item G. Pedro.
All right. So not too much to go over with you all. I did want to touch, I think, just primarily on piece of legislation that was just enacted. It was actually just signed by the governor today. It was passed by the House and by the Senate last week, signed by the governor today, and that is House Bill 3. And effectively what this does, it will amend Florida statutes in various places to require that fiduciaries who are stewards of public assets, public funds, be required to solely invest assets or such assets based on pecuniary factors. And so it would be impermissible for any such body, any such fiduciary to consider outside factors such as you've all heard of the ESG moniker, right? Environmental, social, corporate governance, equality, diversity, anything like that would be prohibited. And so the statute goes on to define these pecuniary factors as essentially these empirical data points that you guys all receive and discuss with your consultant. So things such as performance and fees, standard deviation, alpha, right, beta, all of these kind of empirical data points are really the only things that can be used when making these decisions. Ultimately, the goal is that the fiduciary's decision should just be based solely on making the most amount of money possible, right? And so anything outside of that, i.e., maybe environmental or social governance or something to that effect, is improper and now, based on this law, impermissible. So, and we've been having this discussion with a number of our clients and a number of our consultants. I know, Carrie, we just had this, I think, last week with another client. And really, it's a little bit tricky in the sense that there's not, as with any new piece of legislation, right? There's no clear-cut lines as terms of bright lines in terms of what's right, what's wrong, and what's in between. It's really rather ambiguous in the way that it's written now. It certainly lacks some clarity from our perspective. So what we're hoping for is that the state will issue some sort of guidance, but more likely would be just as time passes and as the law gets challenged in the court system, judges will make decisions, issue verdicts, issue rulings, and so therefore that will essentially start outlining what the law entails, how it's supposed to be interpreted, or how it has been interpreted rather, and what's right and what's wrong based on this law. From our perspective, and I think you guys we just went through this exercise, right? And none of my clients, with the exception of maybe one or two, really practice this anyway. In other words, all of their decisions are based on these quote-unquote pecuniary factors. But kind of this rabbit hole that I was mentioning earlier, right? So where does it begin or end? So if the board is, for example, considering a manager, and I'm just going to use one, not specifically because it's them, but just because I know that they have these kinds of scoring criteria as part of their process. And so BlackRock, for example, always has an ESG score for a lot of it has proprietary funds as well, but as part of its materials, as part of its process, there is this ESG component to it. And so the thought is essentially, even if the board doesn't consider that, but if the board hires a manager that does consider that, then does that, by implication, right, does that mean that the board essentially considered it as well, right? And so therefore would be in violation of this new statute. I don't have the answer to that. My initial reaction would probably be no. But these are the kinds of questions that I think are raised by this new bill and the way that it's written, in that it just really doesn't define kind of where the analysis should begin and where it should end. So we've been working with, not only our colleagues on the pension side, but also city attorneys as well. This does impact municipalities, fire districts, any agency, counties that are going to issue a bond. This would also apply for those for the issuance of a bond. In other words, there would be they would be prohibited from issuing a bond if it was for one of these other factors, right? Except for the pecuniary factors. Similarly, any kind of procurement, right? For where these procurement processes go on, removing such criteria as diversity or environmental social governance or anything like that would now be required as part of a city's or a county or an agency's procurement process. Similarly for custodial banks around the state. So any bank or trust company that is housing or custodying public assets has to undergo specific requirements provided in the statute to be certified by the state as a qualified public depository. So any such institution would also be subject to this new law. So therefore, if it's going to issue a bond, if it's going to issue for a short-term investment vehicle or for a sweep vehicle that it may have, right, it's going to need to abide by these same conditions. So it's a pretty substantive bill. We're not exactly sure how we're going to go about it. I think some of the thoughts we've been having, especially with our consultants, is to include specific language as part of our investment policy statement, part of the board's investment policy statement, just outlining the statutory requirement, right, those pecuniary factors, and explicitly stating that we're not considering anything outside of that, including messages, disclosures, and as part of the motions when managers are made or when allocations or investment decisions are made. So we have it as part of the record. We are going to have to include some disclosure language on investment management agreements, and we will likely have to look at proxy voting policies. So right now, as shareholders in an equity fund, right, or owning equities, if you're in a separately managed account, you have an individual ownership, right? So therefore, every time there's a corporate action, there's a vote that's taken of the shareholders. And while generally this is delegated to our investment manager, based on this new statute, we may need to carve out certain votes, right? That should only be taken based on these pecuniary factors and not anything else. And so, it has a lot of tentacles. There's a lot of room for this to kind of go. So we're digesting it now. We're trying to put together a summary of the new bill, as well as a plan of action. Like I mentioned before, just kind of in concert with all the other consultants and attorneys that are in the space. So we'll have that for you for your August meeting. I just wanted to let you know it's out there, that the law did pass. It will go into effect July 1. It does not affect existing agreements or allocations or decisions. It would only, at least seemingly in our opinion, affect going forward, right? So, we'll have that as part of our report for the meeting, and we can kind of go from there.
So we just can't say, hey, we want to go with X investment because they're have a higher ESG score, or they're pro Chevron and pro oil and pro drilling, all that kind of stuff, right? It's better to just stay away from those things, which we never do anyway, right?
Right. It's never done anyway, but yeah, that's exactly right. So it has to be, the discussion and the deliberation process really just has to be focused on, which is what we do anyway, but has to be focused on those specific data points, right? So when price and fees and alpha and standard deviation or risk, beta, those things, but not, right, to your point, they have a high ESG rating or score, or this firm is a good firm because it's minority owned. Those kinds of considerations would be or are prohibited now.
Okay. You guys got anything on that?
No. Nope. We're good on fire.
Cool. Thanks, Pedro.
Okay. And then lastly, I'm sure Deb's going to remind you guys, but just in case, your financial disclosure forms, since we're not meeting again until I think it's August 1st or 2nd, they are technically due July 1, but most certainly by the end of August, you really got to get that in because they will start assessing those penalties as of September 1st. So just wanted to put it on your radar. We do have some time, but if you are so inclined, you want to move that off of your plate, you can go ahead and just take care of that. Recall you can submit it online, attach it to an email. So, and then obviously anything you need, just let me know. I will also mention, just as a point of reference, there has been a new bill, and I haven't checked if it passed yet, but there has been a new bill that was being considered by the legislature that would enhance the disclosure requirements for the financial disclosure forms. When the bill was first submitted, it seemed as though it was only for elected officials, so it would not apply to you guys. So if you hear something about that or anything like that, it doesn't apply. You don't have to worry about it. So I just wanted to let you know, just in case that comes up somewhere. If we have any city council members or any elected officials on our board, obviously, then it would apply. But I don't think that's the case.
Okay.
All right. That's it. That's all I had.
I have a couple for you.
Deb's got a couple for you, Pedro.
Okay.
All right. I have the cancer policy that you did for the ordinance. I've got that.
Can you hear her, Pedro?
Yeah, just barely. I
Okay,
heard
I'm gonna
some-
move you over. I'm gonna move you over to her.
Okay, I have the ordinance for the cancer policy. And it hasn't gone before the commission yet because I did send it to Foster & Foster for a impact study on it, which I haven't gotten back yet. The Secure Act 2, I don't have that in ordinance form yet.
Okay. So it's really up to, it's up to you. I guess it would just depend on the Secure Act ordinance. We have 5 years based on the regs to get that in place. So we have plenty of time. We're in the process of kind of getting that together now for all of our clients. So we'll probably have that for you, certainly followed by your August meeting, I would say, probably before then. But I don't want to hold anything up. But, at this point, if we want to wait till we get both of them as part of one, I'm okay with it. I don't think the state's going to have an issue with it. So
Okay.
it's really just kind of, I'll defer to you, Deb. If you think it's okay and you want to move it forward with the cancer, just go ahead and then we'll come back with the Secure Act amendment, or if it's just taking a bit and then we can get to the Secure Act amendment, you want to put them all together, we can do that too.
It'd be nice to put them all together, but that's up to the fire departments. It's their cancer bill, so
Yeah.
Yeah, the thing is, it's a state law, right? So
Yeah.
whether or not it's in our ordinance, it still covers us.
It's the overriding policy, it's a state law. Yeah.
Folks were a little bit surprised by the state. They had never mentioned that they wanted it included or adopted, but it's part of the annual report, right? So I think it caught most of us off guard.
Right.
So again, I don't think it's not pressing from my perspective. I think, we already submitted our annual report, we advised them what it is, and we're in the process of getting it adopted. So I think
Okay.
we should be fine.
Sounds good.
I have a question for Pedro, too. You want to bring him back up?
All right, Pedro, Latham's got a question for you on the fire side.
Okay.
It's just an organizational question, and I haven't even referred this to our board side yet. But I technically will be going into drop on June 1 of this year. And I think it's more of an optics issue. Like while I'm in drop and also gaining from the plan with my investments and all that stuff, I would like to cede my chair to another one of the members. And I'm still be on the board, but the chairperson seat, I would like to cede that to somebody else, if that makes sense.
Sure, absolutely.
Now, what's the process for that? And before I totally surprised, and before
I think, Deb, do we elect officers basically once a year? Is that how we do it?
It's twice a year.
Every
I'm sorry, every 2 years. Every 2 years. It's supposed to happen.
Every 2 years.
Every 2 years.
Nations for your successor, right? For another chair.
Yeah.
And then the board would just vote on that at that point. So.
Okay.
Nothing too involved.
Now, is it appropriate to discuss that among the board, even not at an actual meeting? Like if, you know, or should it be just discussed, like I said, in the sunshine at like this meeting?
No, right. Yeah, so you should discuss it. Obviously you can discuss it with your professionals, right? With myself, with Deb, with anybody on the police board. But with your fellow trustees, no, you should wait until the meeting.
Okay, but now is an occasion too. I mean, I'm first bringing this up now. So.
Yeah, now would work too. Absolutely.
Yeah. Okay. I would just like to say something because this person does not even know that I was thinking about this, but I would like to compel Michelle to take the chair because you have time in the seat. You've been here for a while. You're in the trust of our firefighters, and you obviously show intelligence and wisdom in the position. So I would, if I could nominate somebody, that's what I would do if we could put it to a vote. But if not, I can then table this to August. So
I like the compel.
just know that's
Compel
my
versus-
intentions as a fellow board member, and that we're at an actual meeting. So, and my idea is that I will be going into drop, and like I said, my investments with my drop funds will then be commingled and everything. I just don't want the optics to show that I'm steering anything in any certain direction. So, if I'm a partner trustee rather than a chair, then I think the optics are a little better moving forward. So that's part of my reasoning. So, and I've enjoyed the position up to this point. It's not an issue I'm trying to dip out. I think the optics are correct. So that's my take on that. So, but moving forward, like, should we just hold the vote next meeting? Is that appropriate, or is it something we can make a motion now?
You can do it now, or you can wait until the next meeting. It's up to you.
Okay. Then I would ask, is there any discussion on this?
I guess it's up.
Any objections or discussion? I know it's sudden, but if you'd
Why
like.
don't we make a motion next meeting? I'm fine with it, but I think that gives the others
Yeah.
time to process, or if they'd
Okay,
like to
then we
be
can
involved.
push it to
Yeah.
next meeting, okay?
Yeah.
That's plenty, that's perfect, so. Okay, so we'll put this on the agenda for the next meeting and do the vote.
Okay, sounds good.
I do have one more thing to just very quickly, and it's not for you, Pedro. So thank you for everything. But no, you're awesome. Do you have anything else for us before?
No.
Okay. Okay. Sorry. So we have a new member. Because Hausler's position was vacated.
Right.
So we had 3 people initially who wanted the position.
Right.
Now we're down to 1. They've all worked it out. They don't want to have a vote, so they just want 1 person. We've confirmed with all 3 of them, correct?
Sir, yep.
Okay, so Bill Stanley's going to be the next representative,
Okay.
and he'll be at the next meeting.
He'll be the next meeting. Okay, so I'll send him the paperwork that he needs, and
Yep.
I'll send him stuff.
Yep.
Okay, all right, that's
Okay.
fine.
And that's all I got. You guys got anything else? You guys got anything else?
Anything else?
Deb?
No?
Pedro, you good?
Yes, sir. I'm very good. Thank
All
you
right.
so much. I appreciate it.
Yeah, next meeting, August 1st, 2023, 3 p.m. Do I have a motion to adjourn on the police side?
Motion